So I was just in a room and they were talking about something that you had mentioned previously regarding saving for a child's education.
Yes.
And so now that I'm sort of turning my corner from being in debt to having some cash flow, my question is about places to put money for an education fund. And they, like you, saw other opportunities beyond just the simple 529. And they had brought up something that you had brought up. I'm not very familiar with this, but some kind of a cash flow policy, but I wasn't really clear on what that meant. Maybe you know, or maybe you can tap into ways that I can put money away for my child's education, but not be limited to education, because maybe he wants to start a business or maybe he wants to do other things. So I hope that vague question is something that you can help me kind of clarify in my mind how to prepare for my son's financial possibilities.
Are you able to see our screen?
I'll be there in just a second.
Okay, because I have something on the screen for you. All right. Listen, folks, what we're talking about is in 2020, the pandemic year, our company happened to be number 3 in the country in helping people to get this type of policy. It's called a permanent policy, and this particular one is called an IUL, Index Universal Life. And I'm going on record right now. I am not a licensed insurance agent. This is not financial advice. It's just for informational purposes only. I hire licensed insurance agents to offer this policy. I have never sold one. I don't intend to, but I've picked up a lot of information along the way from our insurance agents. So if I say something that's a little bit out of place, if you're an insurance agent, just raise your hand and come up on the stage. I don't mind the correction. Okay. So again, I am not an insurance agent. This is not financial advice. It's just for informational purposes only. Husan, are you there, buddy?
Yes, I'm on the site. I'm looking forward to getting some knowledge.
All right. So this is called an Index Universal Life policy. And what we're talking about is a policy that it takes care of your insurance, but it also builds cash value. And as it builds cash value, that has a lot of benefits that go along with it. One of the things is, let me give you an example. Let's just say that over a period of years, you can actually build it up so that you have $100,000 in cash value in this policy. Okay. Number one, your money grows in this policy tax-free. Tax-free. You know how you put your money in the stock market or you put some money into some other investments, and then as that money grows, that money eventually will become taxed. This money grows in here tax-free. It will never be taxed. Okay. So the other thing that we're talking about is this. Once we get that cash value in there, all right. So what we're doing is let's say we have that $100,000 and you want to borrow $50,000. If you have $100,000 in your cash value in your insurance policy, they have to lend it to you, and you don't even need a job. It is required. They have to lend it to you. So now, does that reduce my $100,000 that I have in the policy? Absolutely not, because you're not borrowing your money out. You're borrowing the company's money. They're using your money to guarantee that money. So here's what's happening. You can borrow $50,000 out of that. And then since you borrowed it, you can set up a payment plan that benefits you. If you borrow that $50,000 to, let's say, to buy a car or to pay for some education or whatever, all right, to start a business, you pull that money out and then you set up a payment plan to yourself with interest, the same interest you would have paid a bank, the same interest you would have paid someone else to lend you that money. You can pay it to yourself, pay the loan back, and that interest money that you put back into the policy, do you realize the company has to start paying you interest on that interest money and grow your policy even more? Let me give you an example here. This is a young person at age 26 coming into this policy, got this policy and putting $500 a month into the policy. $500 a month. Here's what we're looking at. Okay. So starting at age 26 and 10 years in, that would be right here. Okay. They would have $60,000 into the policy that they put in. All right. Now, on year one, the death benefit on the policy is $347,000. That's the death benefit in year one, right? Even when they make that first payment to the policy. 10 years in, they have a cash value of $60,000. That cash that they paid in is $60,000, but their death benefit went from $347,000 to $403,000. Now, the cash value on this in the first 10 years is the $60,827. So only $827 more than they put in. That's the first year. But if they wanted to borrow some of that money out, they could. How about that? Now, let's go down and look at the next 10 years. At the next 10 years, they have $120,000 paid in, but the cash value is $197,000. Now, this is a projection. It's an illustration. Okay. So anytime you do a projection or illustration, it's projected to be this based on historical data of about 6% compounded interest on this policy.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L.L method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.